What's going on, everybody? Hope everyone is doing amazing. We're going to talk about here in just a second how to grow a small account. So we'll go ahead and wait just one sec for some more folks to pile in here. There we go. Some more people joining. There we go. Let's double check, make sure chat is working. If you guys can, go ahead and tell us where you're from. Maybe if you're out of the country, outside the US, tell us what country you're from and give us a little bit of feedback on where you guys are tuning in from. Hello, Billy. Okay, yep, awesome. That Peter. Hello, Peter. Vancouver, Indiana. Okay, awesome, awesome. Okay, so let's go ahead and get started. Before we dive in, just a quick disclaimer that Options Pilot provides education, not financial advice, certainly not personalized financial advice. We don't trade for you, we don't manage your money for you, we cannot guarantee profits. Trading does have some risk, and you can lose more than you invest. Past performance does not always guarantee future results. Some of what we'll show you today includes historical performance. So keep in mind, past performance is not indicative of future results. As always, trade responsibly and never risk money that you cannot afford to lose. So let's go ahead and get started. How do you trade a small account? There's a bunch of different ways. The big question we get very, very frequently for many, many years, and we finally found an answer, is what do I do if I have a small account? How do I grow it? As most of you know, in order to day trade, you need at least 25K to day trade, right? There is a US requirement. It's called pattern day trade. It's a US SEC requirement. In this case, we figured out a way to do it with a much, much, much smaller account so that you don't have to have, most people don't have $25,000 laying around, right? If you can relate to that, then this is for you. So how do you do it? Well, the answer is SPX option. SPX, as you guys probably know, stands for the S&P 500 index. The S&P 500, the actual index itself. Now, this is a little bit different. Most of you have probably heard of SPY, SPY. SPY is actually the ETF, the electronically traded fund for SPX. So there's two different things here. SPX in this case is what we're talking about. So how do you trade a large asset class that's in the $6,000? How do you do that with a small account that maybe is only 3,000 or maybe 4,000, maybe 5,000, a smaller account? How do you do that? And the answer is with credit spreads. Now, credit spreads are a type of option, and we'll talk a little bit more about that now. So let me just set some background. Some of you guys may be familiar with trading stocks, how that works. And let's draw a couple of conclusions or some parallels between options and stocks. If you're familiar with stocks, let's explain options a little bit more. So number one, options allow you to control a block of shares without actually owning them, okay? Stocks don't usually go to zero. Options often can. Why? Well, options have an expiration, so they can expire. If they expire, they can sometimes become worthless, right? Imagine buying a bag of ice and it melts. It's now not a bag of ice. It's a soggy bag of water. It is not worth anything, right? Options also allow us to take advantage of big price moves with less capital. And that's probably what you guys are here for, is to learn how do you grow a small account, meaning you don't have tons of money. You don't have an extra $25,000 laying around. Most people don't, right? So how do you get around that? We'll talk a little bit more in a sec. And you do need options trading approval from your broker in order to trade options. Usually fill out a form and most brokers will approve you. And then number five is options can give us flexibility to make money, whether the stock goes up, goes down, or even goes sideways. Now, how many of you guys have ever bought stock? It goes sideways for months. It goes up a dollar, down a dollar, up a dollar, down a dollar, which means for months you're not really making any money. Options can give you the ability to make money even with sideways moves, okay? especially with credit spreads. We'll talk more about that in a second. And the other thing is you don't always have to be right on the direction, which, as you guys know, if you've ever bought a call option or bought a put option, you got to get the timing and the direction right. With credit spreads, a little bit easier, quite a bit easier, right? And what we're doing is we're basically saying, where do I think the stock, or in this case, SPX, where do I think it will not go? Now, some of you guys have probably been trading for, 6 months, a year, kind of still new to the trading game. And you guys have learned that it's a little more complex than it looks. It's far more complicated than just clicking a button or two, right? Matt, tell me what button to click. I want to make $5,000 a day. Just tell me what buttons to click. I wish it were that simple. Make our job a lot easier, okay? So just as a comparison, obviously stocks here, there's a few things you need to know about when you get into a stock trade. However, in options, as you can see here on the right, a lot more moving parts, a lot more complicated, not necessarily complicated, a little more to it than that, right? With enough practice and experience, things that appear complicated or appear intimidating aren't so when you get some practice, right? So same thing, symbol. So obviously in this case, we're talking about SPX, right? When it comes to options, they're referred to, they're not shares, they're option contracts. And one contract controls 200 shares. So for those of you with a master's degree, 5 contracts controls how many shares? If 1 to 100, 5 contracts equals how many shares? If you said 500, you would be correct. 500 shares, okay? 500 shares. Now, you do have to buy to open and sell to close. That's when you're going long options. In this case, with credit spreads, we're going to do a little bit of a combination of these two. We're going to buy to open and sell to open, right? We're going to do a little bit of, we're going to kind of put in 2 trades at once, essentially, right? And we'll talk more about that in a sec. And then, of course, calls and puts. Call, you buy a call when you think price is going to go up. You buy a put when you think price is going to go down, okay? Now, the easiest way to remember this is calls, when you buy, of course, when price goes up, and you think of it like a coupon, right? Most of you guys can relate. A coupon is where you buy something and you save money. You get a discount, right? And obviously, the put options are the opposite. What's the opposite of a coupon? Insurance, right? You guys can all relate to and understand what car insurance is, right? If you think something's going to happen, you can buy insurance and you can get paid if price action moves lower, right? So call options are for when price action, you buy a call option when price goes up, you buy a put option when price goes down, okay? Now, I just a second ago mentioned a little twist on this, and that is that credit spreads are 2-in-1, 2 pieces, okay? So let's talk about the 2 kinds of credit spreads. Number 1 is called a bull put spread. A bull put spread. What the heck is that? Well, it sounds a little confusing, ladies and gentlemen. It really isn't. Number 1 is, the first word is bull, meaning you think you're bullish. You think price will go higher, right? So bullish, bull put spread, okay? A bull put, you're like, oh, what are those? Are kind of conflicting, Matt, in my head. I thought a bullish means when you think price is going to go up. A put means when things are going to go down. Oh, yes, but a put in this case are the instruments. We're using 2 different kinds of put options, 2 different put options. So we think price is going to go up, and we're using the instrument of put options. A spread, what in the world is a spread? Well, we're going to talk about that a little bit more, but basically you're using put options. So that's what that second word means. Spread is 2 legs, right? So sell, you're going to sell one level, sell to open, and you're going to buy another level, okay? So let's think about this for a sec. Number 1, we're going to sell premium. Now remember I said a put option, you're pretty much buying insurance. In this case, we're going to be selling insurance. Someone asked, Matt, why do I get paid immediately at the front end of the trade? Well, you're selling insurance. Have you guys ever got car insurance and they did not ask you for money up front? That never happens, right? You get paid on day 1. Now, what you're hoping when you're selling insurance, you're hoping that there's no insurance claims, right? If you're selling car insurance, you're hoping there's no insurance claims. So you collect the premium, right? The policy expires, you have no claims, money in your pocket. Okay. So in this case, what we're doing is we're selling premium and we're collecting money up front on the short leg. What does it mean by a short leg? Well, that means that you're going to have two legs, a long leg and a short leg base. And I'll show you more about that in a second. We're going to sell short here and we're going to buy here. So we're using two puts. We're going to buy one level and sell another. That's kind of where the idea of a spread comes from, is the difference between these two strikes. Okay. So let's talk about this a little bit more. What we're going to essentially do is imagine, just hypothetically, if we sell insurance for $300, okay, and we turn around, let's say we get a positive 200, and we turn around and we buy our own reinsurance. How many of you guys have ever heard the term reinsurance? That might be a new term you've never heard of. As you guys know, in the US, Geico Insurance talks a lot about reinsurance. What the heck is reinsurance? Well, imagine you are a insurance company and you provide home insurance, homeowners insurance, property and casualty insurance, P&C. You provide insurance to, let's say, hypothetically, a lot of luxury homes in Los Angeles, and you're insuring against fires. Well, as you guys can recall, beginning of this year, early 2025, in January, there was a lot of luxury home fires, celebrities, lots of famous people, their houses burnt, right? So what do you do if you're an insurance company? You don't want that to sink you. What you do is you buy your own insurance. So imagine collecting 300 bucks. It's like you're selling insurance, but you use 200 of that to buy your own, we'll call it reinsurance, okay? And you get to keep the difference. You keep $100. Now that's not $100 like Matt, like $100 doesn't excite me. I spend that every week on gas, or that's, two things at the grocery store. It's $100 per contract, right? So if you have 5 contracts, 10 contracts, 20 contracts, maybe you have a bigger account, 40, 50 contracts, that becomes a much bigger number than $100. Okay, it's per contract. So 100 times 1, 100 times 5, 100 times 50. Makes sense? So what this looks like, if you're looking at it like on a stock chart, is we're essentially betting for a move not to go below a certain level, right? So it's like stock, the price is going like this, and we're just saying we don't think it's going to go below here. And if it does, guess what? We have our own insurance that we paid money for that limits our risk, right? And so the idea here is we sell, collect some money, turn around, use a chunk of that to buy our own insurance. So let's take a look at how that plays out. Is basically we're betting price does not go below the red line, right? This is our short leg and this is our long leg. This is where we collect money. This is where we buy our own insurance. And that's what it looks like if you were to set it up on a chart. Now let's take a little bit and we'll look at the opposite here, which is a bear call spread, And what this is basically the same thing in reverse. Now, bear means lower move, going lower. And a call means what? And the call means we're using call options, right? So it's like the instrument we're playing with, the instrument we're using. So we can make money when price goes up, we can make money when price goes down, and we can make money when price goes sideways. And I'll talk more about that in a second. You're like, Matt, how do you make money on a stock that goes sideways? Oh, with options. I'll show you in a second. Okay. Number two, there are two legs. You sell short a call option, you buy another. Remember, we're collecting 300 bucks on one leg of this, and then we're 200 of that. And these are just examples. Obviously, it's not exactly that each time, give or take, but that's the kind of the range. And typically we are selling, or we're always selling premium and we're collecting money on the short leg. And we use some of that money as some of the premium we collect immediately on as reinsurance on the long leg. So this is what it looks like on a chart. We're going to collect 300 bucks right here, say plus 300 again per contract. We're going to spend 200 of it and we're going to net 100 per contract. And we're basically saying, I don't think price is going to go above this level. That's it. It's pretty simple, right? Now, setting up these orders and all that, there's a little bit to it. with a little bit of practice, it's actually more intimidating than it is actually difficult. So let's recap, review. One leg is short. We're going to sell to open. This is kind of like the lingo, STO, sell to open. Now, if you've ever bought a call option or bought a put option, that would be considered buying to open, right? This is sell to open. So we're selling it, collecting the money, okay? We're going to collect the money, collect premium. Money goes in our pocket. Let's say in this example, $3. And we're going to have minus one, our quantity. If you've ever bought like 100 shares of Tesla, it'll say 100 TSLA, right? In this case, it'll say minus one SPX, okay? And it'll have like some numbers after that that represent the expiration date, like when it expires. Okay, so one leg is short. The other one is long, which means we're going to buy to open. So we're buying our own insurance. Remember, I said a put option or a call option, either one. The put options are you buy them when you want insurance, right? Again, we're collecting $3, positive $3, and then we're using two of those $3 to buy our own insurance. The premium is the difference. Okay. So we get to keep the difference. Again, $1 per share, or you could say it is basically $100 per contract. Now, most option prices are expressed in a per share price. So if you hear someone said that they sold it and got $1.10, $1.20, $1.15, it's all per share. That means $1.10 would be the equivalent of $110 per contract, right? Per contract. If you got $1.15, right, it'd be $115, right? That's the idea. So if someone says they sold it for 95 cents, well, that would be $95 per contract, right? And the difference, the spread, is basically the difference between these two prices. For easy math, I'm using 3 and 2 for an easy $1. You guys can do the math. 3 minus 2 is 1, right? But obviously, maybe you bought more, sold less, or whatever, and the prices, the difference is expressed as a price for the spread, and whatever that is, you keep the difference, right? So imagine selling something, collecting 300 bucks, turning around and spending 200 of it yourself as reinsurance, right? You don't want a catastrophic trade to blow up your account. You're buying your own insurance. And because of that, obviously in this case, you can do more, but in this case, in this example, we have 5 contracts, which are basically collecting $500, right? So $100 per contract times 5 contracts is $500. Is this making sense? Okay, awesome. Okay, so let's do a quick like visual, like what does this look like? Remember, credit spreads are two-legged option. Here is a bear call spread, and we're basically betting the price will not go higher than the short strike. The short strike, how do you know? Well, remember, a short strike, the quantity is expressed as a negative number. You're upside down, you're selling one of these and you're buying the other. So +1 is your positive, your insurance. -1 is what you're collecting for your premium. It's basically you are selling insurance against it going higher, right? You're selling insurance against it going lower. And you're basically betting what? That price is going to go above or below, right? So a bear call spread, we're betting the price is going to go below. Oops, let's do it like that. There we go. We're betting it goes below that price. A bull put spread, you're betting price is going to stay above a certain price. Okay. So let's take a look at what this would look like if we're actually looking at like a traditional stock chart or traditional chart here. You'll see a bear call spread. We have a short. Remember, we're collecting 300 bucks here, plus 300. We're selling 200. And we're betting price will stay below our red line, right? Over here, same thing in reverse, bull put spread. We're betting price stays above our price line, our red line, our short strike, okay? So let's recap. Bear call spread is bearish trade using call options, that's an instrument, and when you think price will be flat or go lower, okay? Now, bull put spread is kind of the opposite. A bull put spread here is it's a trade when you're using put options and when you think price will be flat or higher. Now, what does flat mean? Well, if I have insurance, I'm selling insurance here and price just goes sideways for an entire day, what happens? Do I have an insurance claim against a lower move, crossing my line in the sand? The answer is no, I don't. Which means what? Which means I sold insurance premium, I collected money, and I had no insurance claims, right? So it works pretty well in smaller accounts. Obviously, um, you have to get a little bit of practice how to put these orders in, but it's actually more intimidating than is difficult. Okay, so let's look at this again. Bear call spread. Again, you have two different legs, of course, and you sell basically what's called a 10, an option that's a 10 delta or a delta of 10. Some brokers express it as a 0.10. Some will just say 10. And it basically means how far is the current price? Let's say the candle is currently right here. And we're going to say we don't think it's going to go above this by the end of the day tomorrow. So obviously today is, let's say today is hypothetically a Thursday, which it is. We don't think by the end of the day Friday price is going to go up here. Remember, we're betting against a lower move for a bear call spread, right? So let's look at it the other way around. A bullish trade using put options. Remember, bullish trade using put options, right? Names are pretty straightforward. Takes a little bit to kind of comprehend and kind of understand. Once you get a little bit of practice, this becomes pretty simple. And you're basically doing the same thing. You're selling a delta of 10 or a 10 delta put option for $3. You're spending three of those on your own insurance, $2, and you keep the $100 contract. Now, some of you are probably thinking, well, Matt, if I didn't use insurance, I could keep all $3 or $300 per contract. And the answer is yes, you could. However, you have to understand this will also help your buying power. So again, small account, you cannot, a small account will not let you do this. You have to have big bucks if you plan to do that. And we're talking about small accounts here. So don't recommend that. Number one. Number two, your broker won't let you do it in a small account. Okay. Because it's a humongous risk. If you're trying to do that, trying to save a few bucks. Okay. Think about that. So again, these are the types of moves that we're looking at. The two different kinds of credit spreads as a recap. Bear call spread, looking for a lower move. Bull put spread, looking for a higher move. Okay. So again, let's recap how this works, the mechanics of it. We're going to collect $3 and we're essentially selling insurance, right? Does that make sense? We're selling insurance. And because we're selling insurance, we collect that money up front, right? And then we're turning around and spending $2 of that on the long leg, and we're going to buy insurance. The difference is we're going to take the risk that we don't think price action is going to go below a certain level for a bull put spread or above for a bear call spread, okay? Now here's a question we get asked frequently. Why would I buy my own insurance for $2? Well, we hinted about this just a second ago. Number one is to reduce risk on the trade. You never want to have an unlimited risk on a trade. I don't know how many of you guys would ever collect $300 and take a $6,000 risk. Even if it has a high probability, the math doesn't work. The math doesn't make sense, okay? So to think about this is you're putting a cap on the amount of risk you're going to take. You're limiting it. Because you're limiting it, your broker would say, okay, for a small account, like a $3,000 account, for example, you can trade 3 contracts max, right? 3 contracts. Why? Because roughly $1,000 per contract. Sorry, $1,000 per account. $1,000 for every 1,000 in your account, you get to trade 1 contract. That's max risk. Okay. So again, we're going to collect premium, a net positive, obviously $3 plus $3. We're going to collect minus $2 is going to give us a premium of $1, right? The difference, $1 or $100 on the contract. And that's basically on day one. Okay. So how does this work? Well, typically what we'll do is we will close the trade for 5 cents. So we sold it for $100. We're going to close it for 5 cents on day 2, right? So we're literally in and out again 1 or 2 times a week. Now, the reason that this is super powerful is why? Well, there are multiple ways to win. What does that mean? Well, let's say that we have a bear call spread set up. We're gonna, collect money here. We'll say plus plus. We're gonna spend some of it here. So three pluses for 300, minus minus for 200. We're gonna spend 200 here. Well, how do we win? Price goes sideways. Do we win? Did it go above my red? Yes. Or sorry, did it go above my red line? The answer is no. Yes, it did. Yes, it stayed below. Is what I'm saying. Okay. What about if it just goes super low and we're betting against a higher move, right? Which means we do not want it to go right here. In this case, did we win? The answer is yes. What if it moves a little bit against us? Guess what, ladies and gentlemen? This is the power and the beauty of credit spreads. We still win. Isn't that awesome? So let's look at the bull put spread. Same thing. We're betting against a lower move. We do not want price action to cross our red line. Our green line is when our own insurance kicks in. So in this case, it is moving higher. We win. Goes sideways a little bit. We win. Goes down a little bit. Moves against us a little bit. And we still win. Now, the reason that this works so well is because of something called time decay. What does that mean? Well, you guys know as it comes to insurance for your car, most insurance companies offer a 6-month or a 12-month policy, right? Which means at the end of that, you have a set amount of time to have a claim. After that, you got to pay again, right? So same thing on this. We're opening a trade on day one. We're closing it on day two. So we're only betting that for the next roughly 36 hours, price action is not going to go above this line or go below over here. So it's going to stay below for a bear call spread. It's going to stay above for a bull put spread. Does that make sense? Let's look at some actual trades that we took. And so this is a bear call spread. We collected $450, and that's for 5 contracts in this example. Price stayed below 63.95. So 63.95 is up here, and you'll see price went kind of sideways, and we got to keep all of the premium. Okay. Now let's look at the opposite, which is the bull put spread. Same type of thing where we're betting price does not go below, in this case, 63.30. Remember, we're trading SPX, so this is an index, and you guys can see 6,330. So one contract is 6,330. So how do you trade a $3,000 account with an asset that's 63.30, right? How do you buy something where you only have half the money? Well, that's where the power of credit spreads come in, because you're not spending 63.30. You're risking the difference between your two strikes. Okay. So that's what it looks like. Is you're basically, again, a bear call spread. You're betting price action stays below your predefined level. A bull put spread, you're betting price action stays above your price level. Make sense? Okay, so here's what we do have one, and this is how you get around your 25K pattern day trade rule. Most of you guys may know this, but a pattern day trade, the PDT rule, is not a push button trading. It's not any trading group's rule. It is the official Securities and Exchange Commission rules. Okay, it's not something we made up. It's something that we have to. It's like one of those government regulations you have to abide by. You have no choice. Your broker will warn you. They will pause your trading. Okay, and so what we do is what this rule requires is 3 trades. This is if you don't have 25K, 3 trades per 5 days. 3 trades per 5 days. How do you get around that? Well, you do 1 to 2 trades per 5 days. That's how you do it. 1 to 2 high quality weekly trades. Now, what we do is we offer an alert service where we say, hey, I'm entering this. Here's the reason. Here's your sell to open, buy to open. This is what it looks like, right? We're selling a bull put spread. So we're using puts. We're going to sell this level, buy this level, and we're going to collect $90 per contract. Sometimes it's $100, sometimes it's $110, sometimes $115, sometimes even as much as $120 per contract. Okay. Now, some of you guys are saying, well, SPY is like 1/10 of the price of SPX. Why don't we just do SPY? Well, there are actually some unique advantages to trading SPX. One is It settles in cash. SPY settles in the actual underlying ETF, the electronically changed fund. Like you'd say you get shares, right? SPX settles in cash. Number two is there's no early assignment, meaning someone can't have an insurance claim against your trade prematurely. They can only do it at expiration. That's it, which means you don't get stuck if a trade starts losing a little bit and you have lots of time before it ends. You're not stuck in a losing trade. Someone doesn't punch you in the face before the trade ends, before it expires, before it gets to the end of its life, so to speak. Okay. And the no early assignment, that is basically European style option. So lots of advantages. The other thing is, of course, SPX one contract is roughly 10 SPY. Again, this is the ETF, right? This is the SPX is what we're trading and is the index. Yeah. So it's the index. And because it's basically like a 1 to 10 ratio for the contracts, what does that actually mean? Well, less contracts is cheaper commissions, if you think about it, right? Most brokers charge you per contract. Would you rather trade one SPX or 10 SPY? If everything else was equal, what would you do? Well, if you're paying commissions per contract, this and this, I'd rather have a tenth, right? So instead of trading, maybe I'll say 5 SPX versus 50 SPY. If you're paying per contract, which commissions would you prefer? The 50 or the 5? Go ahead and type it into the chat pane. Which would you prefer paying per commission? Everything else, assuming it's equal, what would you rather pay? Commissions on 5 contracts or 50? Make sense? So how does this work? Like, what's the max risk? What's the max reward? Well, one contract, when you win, roughly $100. Sometimes it's 95, sometimes it's 120. We'll just say 100 for easy math. But when you lose $300. Now, this can sting at times where you're basically risking 300 to make 100. But think about this. When you have an 87% win rate, almost 90%, that actually works out in your favor. The statistics are in your favor, right? So your ratio is 1 to 3. Every $1 you make, you're going to risk $3. So when you lose $3. When you win $100. Now, the 87% win rate is pretty helpful, right? It's obviously a little different than 80%, a little different than 60% win rate. But for every $1,000 in account, you can trade a maximum risk of one contract. Okay. So let's look through a couple different account sizes. Obviously, we're talking about smaller accounts. So we're in the $3,000 to $5,000 range for accounts, whatever your account is. That's obviously not what you're paying us. That's money inside of your own brokerage account, inside of your own trading account. So how does it work? Well, $3,000, you can trade 3 contracts. When you win 300. If you lose, because we're using a stop loss, you're going to lose $900. Same thing all the way down to 100,000. You're going to make $10,000 on a trade, which is roughly 10% of your account. Again, keep in mind this is the maximum that you would want to use. You can do less. You don't have to use your full account, risk your put all of your account at risk or in a trade. Okay. You can't have a $100,000 account and trade 20 contracts. You can trade 10. You can trade less than 100. This is the max. Keep in mind, these are all, I probably should have said max contracts, the maximum you can do. Okay. Now, what happens is you will send out an alert and it looks something like this: trade alert, entering a bull put spread. Here's your reason. Here's the exact order that you would have to set up, and then $95 per contract, or it might say 95 cents, okay, which translates to $95 per contract. Now, it's up to you how many contracts you want to trade. Highly recommend when you first start to trade one, paper trade it, practice it. So let's break down what this information this looks like. Number one is obviously the trade alert, 7/22, July 22. That's what it means, right? Nothing complex. A bull put spread, remember we talked about, is a bearish trade. Actually, that should say using put options. Little typo there. Sorry about that. So using put options, okay? So in this case, what does that mean? Well, remember, we're betting price action is going to go, if we're using a bull put spread, we want price action to go lower, right? We want price action to, sorry, not go lower. We want price action to go higher. So what do we do? Well, in this case, we're going to set this up as a, I fixed it. We're going to set this up as 62.65 put. That's what we're going to do, right? And I realize this is, I need to fix that too. This is a put as well. Okay. So we're basically betting price action will, with a bull put, we want price action to go lower. We do not want price action to go above. We want price action in a bull put. We want price action to go higher. We do not want it to go lower. The opposite, of course, is a bear call spread. Okay. Let me fix this real quick. It's going to drive me nuts. Here we go. Okay. So we got it fixed. So again, sell to open, meaning we're going to remember there's two legs. We're going to collect that $300. We're going to sell cash money on at the beginning of the trade, and we're going to use the 23rd of July, meaning remember today in this case is July 22nd. So on the 22nd, we're going to buy and sell the 23rd. It's always the very next day. And ladies and gentlemen, we don't actually trade these over the weekend. So these alerts essentially come out Monday through Thursday. If it comes out on a Friday, it means we're holding over the weekend, and we don't like to do that. Or we prefer the Monday through Friday, right? So trades will come out on a Monday, Tuesday, Wednesday, or Thursday, okay? So keep in mind, remember, sell to open, we're going to collect $300 plus $300. Sell, this should say buy to open, is we're going to then spend $200. I need to review this one more time. So that's essentially what an alert looks like. So let's take a look at what the chart looks like. And like, how does this look like on a chart? Remember, a bull put spread. So price action is like right here. And we're betting price action does not go to the red line. Okay. Price action does not go to the red line. So in this case, we set up the trade right here on this candle. We're like, I don't think price is going to go here. If it does, we lose. If it goes lower, we win. If it goes sideways, we win. If it goes higher, we win. If it goes a lot lower, that's where we will actually take a loss when it crosses that line or hits, like a stop loss. Okay. So here's what an example trade would look like. It says here, I'm entering a bull put spread. Here's the reason. And it talks about the sell to open, buy to open for a credit of $95. Okay. Again, this strategy is ideal when you expect the stock to stay flat or increase. Okay. All right. Let's look at another example. Actually, here, let's do it this way. Let's go to a bear call spread. There we go. So bear call spread, you're basically betting price action is going to go lower or stay below my red line. So a lot on the screen, don't be intimidated. We're basically saying right here, this is where we're getting into the trade, right? Where are at the edge of this green line. We're saying price is not going to go lower. In this case, you see it actually moved against us, but did not cross my red line. So it moved against us and I still won. It can go sideways and we can win. It can go lower and still win, right? Multiple ways to win. Again, this is really cool for when you're using like a smaller account, okay? So like what does this work with? Well, most popular options broker is Tasty Trade. If you guys don't have a brokerage account, I use Charles Schwab myself. And there are other brokers, of course, that offer and support credit spread options. So Tasty Trade, Charles Schwab, E-Trade, Fidelity, Interactive Brokers. Those are some of the popular brokers that most people use. So let's look at some of the overview here. One is you can start with $3,000. It's kind of the minimum we recommend to get started. $3,000 account. That's not money you give us. That's money you put in your own account, right? And then we take 1 to 2 trades per week. We collect anywhere from, in this case, 9 to 12%. So that basically turns out to be 90 cents to $1.20 per contract, or uh, sorry, per share, and it'd be $90 per contract to $120 per contract. Okay. Remember, that's only one contract. You can trade more. 87% win rate. Okay. So here's a quick overview is again, collect 9 to 12%, up to two. So one or two trades per week. It has to be lower than three to avoid the pattern day trade rule. Okay. Now, what most people will do is they'll sign up for an alert service that maybe gives out three per day, right? Let's say 15 trades a week, for example, another alert service, and people will cherry pick which trades they can take out of 15 trades. And usually they pick wrong. That's why this service is far superior, because we're only doing 1 to 2 trades, and it works with a small account. And if you have a bigger account, you can certainly use a bigger account, but it works well on small accounts. It's designed for small accounts. The other thing is it does work with existing brokers. Most brokers who allow options support credit spreads. Again, we give you a text and email alert. It does work with the smaller accounts. We do include the reason, like why are we doing this? What's the logic? You can do it from your mobile phone. Almost every single trade that I've done from my phone. Why? Well, sometimes I'm at the grocery store, sometimes I'm in a kayak, sometimes I'm on the lake, sometimes I'm running. I hate running, but sometimes I'm cycling, right? The other thing is you can trade options without owning the underlying shares, or in this case, SPX. So how does this work? Well, 1 or 2 trade alerts given per week. So it's text and email. So we're going to do land, air, and sea. We're trying to get it in front of you as soon as possible. The entry reason is given for each trade. There is specific details of what the trade looks like in that text message. And we do provide online videos for how to set up the orders for those popular brokers. And it does work within small accounts. Okay. Now keep in mind, you do not need to know the exact market direction, right? Why? Well, we can go sideways and when we can go lower and when we can go higher and when a lot lower is where we're going to lose. Make sense? So you don't have to really know the exact direction specifically. And you profit again from up, down, or sideways movement. And essentially what you're doing is you're selling that insurance. And you're basically, we call it premium, your option premium. You're collecting a premium. You're collecting some upfront money. Okay. And in this case, all you need is for the very next day to expire, right? So in that case, time is on your side. Time is on your side. So you don't have to worry about buying an option. The price didn't move as much as you needed and the thing expires. You don't have to worry about that because time is, you're on the other side of the trade where time is actually working in your favor. Okay. And it does give you, of course, controlled risk. You have a set amount of risk you're taking and a set amount of reward. You know all of it ahead of time, right? Again, one day hold time. So you're basically, think of it like on a Monday, you're going to exit on a Tuesday. On a Tuesday, you're going to exit on a Wednesday. On a Wednesday, you're going to exit on a Thursday. That's essentially how it works, right? You're going to hold it for the next day. So if the trades will come in, the alerts, and you this way you don't have to constantly watch the market. Have you guys thought, oh, I want to be a full-time trader, but you don't like sitting still in a chair all day every day? Drives me nuts. I don't want to do it. So here's some of our stats so far, of course, from last year. This is pretty interesting. Turned a $5,000 account into a $20,000 account. So what does that mean? Well, you made $15,000 of profit and you still have your original 5 grand, which is your ending balance. Pretty cool, right? 66 wins, 14 losses. This case was 82.5%. Now we're actually doing better this year where we actually have a slightly higher win rate. 30 wins, 4 losses, and our account growth. Same thing. 5 has turned into 15. Actually, these stats were as of I think the end of July, I believe. So we've taken even more trades, but that's kind of what it looks like historically. And I do have to make sure you guys understand past performance is not indicative of future results. These obviously can vary, right? Like going forward, obviously the market has to cooperate. We do have some rule-based reasons for why we get into these trades. So let's talk about the common questions. Why only 1 or 2 alerts a week? And again, it is because of the SEC pattern day trade, the PDT rule. You ever heard of a PDT rule? That's what it is, right? You are allowed three trades any rolling 5 day period. In this case, we're going to be below three on purpose, intentionally. That's how it's designed, right? And that's better than sending out 20 alerts and you have to cherry pick which ones to take and you only can do one or two, right? That means you got to cherry pick the right ones, which for brand new traders is kind of hard to do, right? You're using gut feelings about something you don't really know much about. That's really tough. So that's why we designed the program this way, is so one or two per week. What stop loss rules do you recommend? So we actually have a 3x. You may have seen in our previous slide. We actually have a 3x stop loss, which means no matter what, we're going to collect that $100 up front and we're going to exit at $400, right? Exit at $400. What does that mean? Well, remember, if you collect 100 and you have to close the trade at 400, you've lost $300, and that's kind of how the math works, right? So we have a 3x, whatever the premium is, of course, times three. So if you collect $100, your stop loss would be 400, and you're like, oh, Matt, that's four times. Yeah, but you keep the original 100, right? So you're kind of that's how the math works out. You keep the original 100 no matter what happens. You lose if you have to buy the trade back at $400 when you only collected 100. So your net is minus 300. That makes sense. How long are trades held? Opened on day one, closed on day two. Sometimes we can close it early and just buy it back for 5 cents. So pennies on the dollar, right? Literally. And or sometimes the trade just closes, expires worthless. And because we are selling premium, the strategy is designed to collect insurance and allow that time decay, also nicknamed theta. If you want a cool Greek word to learn, theta, time decay. That's where the time runs out and it works in your favor. So what am I offering here? Well, you can join our online options trading community. You get access to our trade journal where you can see kind of all the trades. We do have weekly Q&A sessions, typically on Thursday evenings, actually coming up here in a few minutes. I'll be hosting that myself this week. Credit spread trade signals up to two per week, so one or two. It's basically when our system, when our rule-based strategy triggers is when we push out trade alerts. And then of course you do get video training for popular brokers. So you don't have to like struggle through how do I do this on my own. We very much actually want you to set up onboarding calls with one or more of our coaches so that you can be successful. And we've learned we actually offer a $25 onboarding credit after you join. You can get a $25 credit off of your, let's say your second month when you sign up with a coach. So I don't know anyone else who does that. Do you guys? You're getting paid to take a one-on-one call with a coach. You get a $25 credit when you set up a call and of course show up to the call. And the idea here is no contract and cancel anytime. So what are the next steps? Well, we do offer a 30-day money back guarantee. It is only $150 per month. And I will put the link here into our chat if you are interested in joining. It is optionspilot.co. And I'm going to, yep, there we go, optionspilot.co. Oops, let's try it this way. Pilot.co. Tim, I hope hope Tracy answered your question. The maximum is every $1,000 in your account, you can trade one contract. Ideally, when you first start, you just start with one, right? You don't want to fumble the order and, you just want to get some practice before you get some crawling before you walk and then walking before you run. Yep. Yep. What other questions you guys have? It's been, you guys have been great. What questions do you have? But yes, start with one contract and get comfortable. Let's see. Blake, what's up? Greg, hello. Joe, Danny, Pete, Rob, Shane, Tim. What questions do you guys have? Any questions? Throw it in the chat. We'll do our best. Otherwise, ladies and gentlemen, that's what I have for you. I will hang out for another minute or so as you guys are typing up your questions. And that's what I have for you guys. Again, optionspilot.co if you are interested in joining. And again, remember, we will give you $25 to take a call with one of our coaches after you join. We give it $25 off. Yep. Which preferred broker? Personally, I like Schwab. Yep. Schwab has a pretty cool tool called Think or Swim. It's a software tool, and it allows you to kind of practice. It's a pretty cool tool. I've been using it for many, many, many years. Yep. Yep. So, yep. And we'll send out the replay of this video if you guys want to watch it again. But Thinkorswim is my preferred. The second is Tasty Trade is kind of the second favorite for the community. But yeah, yep, great question. What else? Rob, what questions do you have? Tim, any further questions? When you're comfortable with the trade setups, what size of the account do you recommend placing in each trade? So it really depends on your risk tolerance. For every $3 that you risk, you're going to make $1. So you have to be able to stomach, like let's say you have a 50K account. I don't recommend you start with 50 contracts because we're going to say 3 times 50 if you lose or 1 times 50 if you win. So it's really a personal decision. We do have some guidance. We can kind of, it really depends on your account, your experience level. Um, Obviously, one contract per thousand is the maximum. So you have a $10,000 account, your broker will allow you to trade up to 10 contracts. If you have a $8,000, let's say $8,200 account, you can trade up to 8 contracts. But it's kind of a personal experience. We do have some guidance once you join the community and how we do that. But typically, most people will step up into, let's say you're going to trade 8 contracts, you kind of step up. First trade is going to be 1, then you second trade is 2, then number 3, then number 4. So if you get a loss somewhere around here, it's not a big deal because you're increasing your size and you have a plan. Of course, that's number 1, and you're increasing your size all the way up to 8 contracts if that's your goal, right? So yeah, yeah, great question. You sure you had it? Yeah, yeah, my pleasure. Cool. Any last questions? I'll hang out for 1 sec more. Otherwise, that's what I have for you guys. Thanks for hanging out with us. You've been great. Thanks. Have a great day. Yep.